Yesterday, data was released that showed the housing market is in a worse period in the last 30 years. Today, I saw something that I thought I would never see in the housing market. We are seeing now the new home builds are being priced at a lower price than existing homes. This is something that has never happened before in history. So if you look at this very closely, you see it did get awfully close there in 2008. And then we saw a big dip where the existing homes dropped significantly during the boom in the last decade of 2010 ish to 2020. And then we actually got very close when we saw the housing prices explode not too long ago at early 2020 to 2021. But now we just see the great flippening occur. And it happened with a vengeance, where now the average existing home sale price is $435,000 and the average new home sale is for $402,000. So what does this all mean for the housing market? Is it that the United States government and everyone else is trying to make more quote unquote affordable homes? Are there new homes being built in areas that are less desirable to live in? That's why people are saying, hey, you know what? We're going to pay cheaper value for this and we're not going to tear down these more existing homes. I don't think that's the case. I mean, if you look at the data, we saw essentially 30-year lows in the new existing home market for the pre-existing home sales and for the amounts of homes underneath contracts. Like not underneath, under contracts. So when we saw those numbers come out at 30-year lows, well, it's got to make you think there's some issues there, right? Even though we saw current sales conditions falling just a little bit at one point and sales expectations holding steady, the traffic of prospective buyers gaining a little bit. It's definitely a buyer's market, to say the very least. I mean, anecdotally, I've seen now a couple friends tell me that they've bought prices homes 100 to 150 to even $200,000 under what they're asking for. And so it looks like this is the crack starting to show in the housing market. And 1/3 of major U.S. housing markets, are now seeing falling home prices. They're saying, the largest 100, 33 of them are showing decline. Inventory has been rising steadily and has been up 29% in the month, but prices are seeing the biggest gains in the Northeast and the Midwest. But there's 4 states already where we could see a crash in the next 12 months. And this is from an article late last month where we could see these potentials. And one of them being Florida, right? Of course, Florida has its crazy gains, ups and downs, the positives, the negatives. I live in Florida, but Florida, Texas, California, and North Carolina, the 4 states that saw a big, giant boom here during COVID, are expected to crash within the next 12 months. But I think it's all connected to the consumer right now, because if you look at the consumer, a lot of the data that we're seeing on it is up and down. It keeps continuing to be revised. Nothing about the consumer that is coming out has been, let's call it positive, right? It's all been somewhat of something that is, I guess, negative in a sense, and not really looking like there's a bright future out there, right? And everybody always worries about the housing market leading to another 2008, but this time it is different. And here's why. In 2008, they were lining out loans to everybody, their mother, their strippers, their whoever. They were getting housing loans that they could not afford whatsoever. Now, people aren't getting housing loans. They just are not buying houses. The United States has a very much consumer economy. And when the consumer stops spending, well, capitalism fails in a sense. So you have to incentivize some sort of spending by one of two ways, either, giving a product of serious value or inflating the money away so quickly that It would not make sense if you did not spend the money that you have today and you waited for it to be half the value tomorrow. Now, I'm not saying that the United States is going to get into hyperinflation by any means, but the consumer is definitely bleeding and being very cautious because of what we see with these job data now being revised. And, there's more complete data, there's some seasonal adjustments, there's some benchmarks, and the Fed, in the US all seem to, let's say, be a bit reactionary to this. But there's something that is out there that we're going to be keeping a close eye on within the next couple of days, where retail data, we're going to look at basically how strong the consumer is. So despite the Fed restricting the economy, a new protectionist trade regime, and a never-ending uncertainty, there's some key moments that we'll be looking at the consumer. So retail giants like Home Depot, Lowe's, Target, and Walmart are reporting earnings and outlooks. So we'll be able to see, based on these guys, these retail giants, just how good the overall retail consumer is doing. As McLovin is saying in the chat, broke people are not buying houses. And that is true, that these broke people are not buying houses, but these broke people are buying things from Home Depot, Lowe's, Target, and Walmart. Especially Walmart, right? I mean, that's the narrative, is Walmart's one of these more affordable, lower rates types of places. So, the US should be keeping a very close eye, or at least the overall, economy should be keeping a close eye on how these earnings go, because this will have a lot to tell with what is going on in the government, right? Or not in the government, in the economy. Are people actually spending? What is the deal here? So when we're watching these, you need to keep a close eye on just how much their earnings are going up, down, whatever. Spending in aggregate increases, drilling down into who and the boosts are coming and going. Total credit and debit card spending per household increased by 2% in July. But while that figure looks encouraging, the report noted that a widening gap has opened between lower economic households and higher income cohorts. So basically, the rich are the guys that are keeping the economy afloat because they keep on spending. Everything is fine, right? So will this continue if the rich start to see, interest rates come down and get cut? Because the rich do recognize this, right? They recognize the dollar is having one of the worst starts it's ever had, right? The US dollar at 98.27, the Dixie, one of its worst starts in 30 years, folks. 30 years. And so everybody's looking at the economy saying, hey, we need more liquidity in the market. There's a lot of uncertainty. We need to be essentially, maybe if everybody who is listening to this would just subscribe to this channel, we would, get a little bit more certainty. I kid, of course. You guys just need to be smoking that like and hitting that subscribe button. And come join McLovin in the chat, because we have an 85% chance just about to cut interest rates here in September. But we do have this big meeting on Friday, the Jackson Hole meeting. So we're going to be keeping a close eye on what Jerome Powell is going to be saying, because there's been conflicting ideologies with all of this, right? The S&P 500 on a generational run. There's no way around it, right? It's doing super well. We have 6,400, right? It's crushing, even though it's down 0.5% today. Overall this year, we've hit new all-time highs. Even though the market is doing well, it seems like the consumer has been struggling. So with all of these revisions and all of the data being extremely unreliable, look, I mean, it makes you, do we need to question the U.S. housing data with all of this? Potentially, right? This could be a potential where we might need to question this data. Is it accurate? But the fact that they're showing this makes me believe that it's very worrisome, because the manipulated data usually makes things look better than they are, right? And so when we see data that looks worse, I tend to believe it a little bit more because what incentive do they have to report this negative data? But the Fed, we will find out on Friday just how quickly, or well, I guess we'll be reading between the tea leaves, just how quickly they plan on cutting interest rates. And of course, this all happens in 29 days, just over, give or take 4 weeks. We'll see what the Fed actually decides to do, and Jerome Powell. I'm going to keep this one short and sweet. Make sure you guys are hitting that subscribe button with the bell notification so you know when I'm going live, and hit that like button for me. And I'll catch you guys all at the next one.